Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next 20 minutes or so talking to you about the COVID-19 pandemic and the impact that it's having on the global economy and investment markets. I'd also like to share some thoughts with you about Adviceworx' view on the current investment climate and prospects for the rest of the year. This year's Olympic Games in Tokyo will be the first and hopefully last edition without spectators. With only 2 weeks to go, the Japanese government declared a new state of emergency in the Tokyo prefecture after a renewed spike in COVID cases. The Games have already been delayed by a year because of the pandemic and has been plagued by controversy and cost overruns. Ultimately, the Japanese government had no option but to impose a spectator ban because it could not afford to host a potential super spreader event in a densely populated country where only 15% of the population has been vaccinated. As of Friday night, nearly 187 million people had been infected with COVID-19 worldwide, and more than 4 million people had succumbed to the disease. The United States remained hardest hit, with 34.6 million infections and more than 622,000 deaths. India, Brazil, France, and Russia make up the rest of the top 5, and South Africa has now sadly moved up to 18th position in terms of the most recorded cases worldwide. There was a significant increase in new COVID-19 infections this week. 38,000 more new cases were reported than last week, an increase of 10%. Brazil, India, and Colombia saw substantial decreases, but Indonesia, Iran, and Britain all saw new cases rise by more than 30%. South Africa's new case number rose by 18%, and our 22,000 new infections were the 7th most on Earth. The Delta variant of the virus is clearly resistant to most vaccines, as is borne out by the fact that new infections are rising fast in countries like Britain, Spain, and Russia, where a large proportion of the population has been vaccinated. This week's global death toll of 54,000 is less than 200 fewer than last week's. India, Brazil, and Colombia saw declines, but Indonesia, Britain, and South Africa all suffered increases of more than 50%. South Africa's 850 fatalities were more than those in Argentina or even the United States. The sharp rise in the weekly death toll in the UK places a question mark next to Prime Minister Boris Johnson's assertion that even though vaccines don't prevent infections, they do protect people against serious illness and death. By Friday night, 1.94 billion people, or 24.9% of the world's population, had received at least one dose of COVID vaccine. 3.4 billion doses of vaccine have thus far been administered, and the daily vaccination rate currently stands at 32.3 million doses. China has administered the most doses with 1.35 billion, followed by India with 369 million, and the United States with 332 million. Based on a number of assumptions about countries which do not provide such data, it is estimated that nearly 1.7 billion people, or 13.5% of the world's population, are now fully vaccinated. There are two major concerns about vaccination. Firstly, the dire shortage of vaccines in poor countries, and secondly, the reluctance of many people to be vaccinated in countries which do have enough supplies. The US Federal Reserve and Chinese Central Bank have both hinted that the economic recovery might need further help, and Asian countries are battling new COVID jitters even as European confidence is returning. Employment and wages are rising in the United States, and houses are becoming even more expensive in Britain. This agreement in the OPEC camp might be good news for motorists, and cyber attacks seem to be here to stay. Car makers, meanwhile, are still battling to obtain enough microchips for all the vehicles they want to build. Southeast Asia has seen a sharp rise in new COVID infections of late, and there are indications that the highly contagious Delta variant is to blame. The spike in new cases has had a negative effect on business confidence, as can be seen in these two graphs. In the Association of Southeast Nations bloc, which includes Indonesia, Malaysia, Thailand, Singapore, and the Philippines, the Manufacturing Purchasing Managers Index rose strongly in the first quarter of this year, but the advent of a third wave has led to a subsequent sharp decline. The same is true of India. Despite the fact that the COVID curve seems to be flattening, business leaders remain gloomy about prospects for the rest of the year. Purchasing managers' indices provide insight into business leaders' expectations about the short to medium-term future. Their expectations are not always realized, however. PMI readings are often highest just before the economy and markets suffer major reverses. These two graphs illustrate this point. In the United States, PMI is currently in the top decile, in other words, among the top 10% on record. The bar graph on top shows that top decile PMI readings normally precede a 6-month period where the stock market declines by an average of 1.5% and inflation reaches 7.5%. Let's hope it's different this time. Equity markets were mostly down for the week, but Wall Street rallied on Friday to erase its earlier losses. Chinese tech shares suffered through another poor week as government's crackdown on US-listed companies continued. Despite this, Chinese investors are buying more unit trusts than ever. US bond yields traded firmer, and the dollar was volatile but ended flat for the week. OPEC Plus could not agree on production limits, which caused the oil price to come off its highs, but gold had a strong week. Automakers Daimler and Jaguar, meanwhile, blamed a lack of microchips for their sales slumps. Most global equity markets endured a dismal week, with the Far East in particular faring poorly. Hong Kong's Hang Seng Index, which includes many Chinese technology heavyweights, was by far the worst performer, while a late rally on Friday pushed the Dow, S&P 500 and Nasdaq into the green. The Nasdaq was also the best performer over the past month, with the A50 bringing up the rear. For the year to date, the Taiwan weighted index is still in the lead, with the A50 the laggard, and for the past 12 months, the Russell 2000 and A50 are top and bottom respectively. Over 3 years, the Nasdaq still reigns supreme, with the FTSE 100 the wooden spoonist. Stock markets rise over time, but not in a straight line. Periods of over-exuberance are usually followed by corrections, which realign the market with the underlying economy. Because of this tendency to revert to the long-term mean, markets are most at risk of a correction when they have risen sharply. This is why some experts worry about prospects for the rest of the year. The first half of 2021 saw the 7th strongest surge in global equity markets in 100 years. The annualized return for global equities over the 6 months following the previous 6 best half years was on average minus 9%. The Hang Seng Technology Index is China's equivalent of the Nasdaq and contains all China's technology titans like Alibaba, Tencent, Meituan, and Lenovo. Many of these companies are dual listed on Wall Street and have flamboyant chief executives who have been known to criticize the government. For some time now, Beijing has been cracking down on these companies in order to make them toe the party line. The market has reacted negatively to this, and over the past 5 months, the Hang Seng Technology Index has fallen by nearly 30%. It was a quiet week on commodity markets with few sizable gains and losses. The oil price fell from its recent highs because OPEC couldn't agree on production quotas, but coal has kept rising. Most other commodity prices were flat, except for aluminium, which lost nearly 3%. Cobalt and coal were the past month's best performers, while precious metals fared the worst. Lithium and coal lead the pack for the year to date, with gold still in negative territory. Here at home, the week's big news was the arrest and incarceration of former President Jacob Zuma. After Zuma had handed himself over to Correctional Services Office at the Escort prison, his supporters resorted to violence and vandalism in an effort to force government to release him. They blockaded the N2 and N3 highways in KwaZulu-Natal, prevented emergency workers from performing their duties, and set 25 trucks alight at the Mooi River toll plaza. Police have made numerous arrests, including 27 people involved in arson and looting in Mooi River, and MK Military Veterans Association Carl Niehaus, who addressed a gathering near Escort Prison and was charged with contravening the COVID lockdown regulations. The Delta variant of the COVID virus is now rampant in South Africa, and both the infection rate and death toll are much higher than during the first and second waves. Nearly 2.2 million South Africans have now tested positive for COVID, and Friday's death toll of 374 brings the total number of COVID deaths to 68,873. Gauteng and the Western Cape have the most active cases and have suffered the most fatalities, but the virus has been taking its toll in the Northwest, Free State and Limpopo as well. Government's vaccination program is progressing painfully slowly, and only about 1.35 million South Africans out of 58 million are fully vaccinated. Government finances are in better shape than envisaged in this year's budget, but COVID relief and public sector wage demands are putting the Treasury under pressure. The rising oil price and weaker rand is making fuel more expensive, and the current ban on liquor sales is costing the industry lost earnings and Treasury lost tax revenue. New vehicle sales are higher than a year ago, but still well below pre-pandemic levels. And our passenger train infrastructure is rapidly being dismantled by thieves and vandals. The South African Revenue Service has been very successful in its revenue collection in the current financial year. Last year's strict lockdown caused a sharp drop in all four main sources of tax revenue, as individuals earned less income, motorists used less fuel, companies made less profit or even closed, and fewer taxable products and services were sold. Since the start of the 2022 tax year, revenue from income and company tax, as well as the fuel levy and VAT, have risen to above pre-pandemic levels, but VAT receipts have declined in recent months as consumers have deferred discretionary spending on big-ticket items. South Africa rose to international prominence because of mining. Diamonds and gold attracted European immigrants and led to a bloody war which cost the lives of 75,000 people. Later, bountiful deposits of coal, iron ore, and platinum group metals added to the country's bounty. Today, gold mining in South Africa is in terminal decline, and coal is under attack by environmentalists. Fortunately, we also possess metals which are in high demand in the greener economy of the future. Our big three miners, BHP, Anglo American, and Glencore, particularly the latter two, produce much of the world's supply of metals used in electric vehicle batteries and hydrogen fuel cells. This could ensure that there will be life after gold and coal. The JSE ended the week flat, with the financial and resources sectors rising, but industrials lower. Naspers and Prosus are suffering the effects of China's crackdown on its technology sector. Bond yields and the rand both ended slightly firmer. The Liquor Producers Association wants tax relief from government, and the share swap between Naspers and Prosus has been approved by shareholders. EOH could be sanctioned for its role in state capture, and Barlow World Logistics is being courted by Dubai's port operator. Foreigners were net sellers of South African securities again last week, but the outflows were less pronounced than the week before. The JSE suffered a loss of 3.65 billion rand, while the outflow from the bond exchange was a third of a billion rand. For the year to date, the JSE and the bond exchange have both suffered outflows of over 42 billion rand. Resources used to be the biggest sector on the Johannesburg Stock Exchange. The decline of the mining sector and the rise of industrial giants like Richemont and Naspers changed the JSE's sectoral landscape. 6 years ago, industrials made up nearly 6% of the JSE's market capitalization, financials over 30%, and resources only 11%. The past year has had a dramatic effect on the sectoral split. The COVID pandemic has put financial and consumer stocks under pressure, and the drama around Tencent hasn't helped. At the same time, higher commodity prices have boosted the resources sector to such an extent that its share of the JSE's market capitalization has more than doubled. The second quarter of 2021 has been a volatile one on the JSE. Some perennial favorites have lost ground, and previous losers have come to the fore. Some of the notable gainers include Distell, which has received a tempting offer from Heineken, Dis-Chem, which is benefiting from a rise in medicines demand, hotel and gaming companies Tsogo and Sun International, which will benefit from travel and tourism when the economy reopens, and a number of retailers. Among the big losers are mining and resource companies whose cycle seems to be turning, Naspers and Prosus, and Steinhoff, whose troubles are far from over. This table compares the performance of the main asset classes and inflation annually over the past 5 years, and summarizes performance over the past 5, 10, and 15 years. What is immediately apparent is that foreign equities have been the winning asset class more often than not. Secondly, prior to June 2020, South African equities had performed poorly and regularly returned less than the inflation rate. Since 2017, local bonds have been the premier asset class on a risk-adjusted basis and have returned double the inflation rate. To me, a key takeaway is that equities remain the key to a successful long-term inflation-beating strategy if one is prepared to remain invested through the cycles. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make at least some sense of it. Should you have any further queries or questions, please don't hesitate to contact me or your Adviceworx financial advisor. All the best for the week ahead. Goodbye from me.